Good afternoon. It's a pleasure to return to the Empire Club to discuss the outlook for gold and precious metals in 2011. I know this may appear to be somewhat of an enviable job, getting to speak about the one asset class that seems to continually outperform all others year after year. But it's a double-edged sword. I've struggled to find an appropriate simile. The best I can come up with is that speaking about gold is like one of those good news, bad news jokes. You know the ones. Your doctor phoned with some good news and some bad news. The good news is that they will be naming a new incurable disease after you. Well, in this case, the good news is that gold is rising. The bad news is, well, nearly everything else about the economy. This year we traveled to the Middle East, the Far East, and South and Central America to discuss gold. The different mindsets about gold that we encountered there surprised all of us. Most people in these countries see gold as a protector of wealth. In the West, we view gold as a commodity for speculation. Western economists treat the act of buying gold as an admission of defeat, and their attempts at disparaging gold's steady rise came even more tenuous than ever this past year. Some of these disparaging opinions include: financial tightening will cause commodity prices to fall. Gold is in a bubble. The gold stocks haven't confirmed the gold bull. And perhaps most desperate of all, the economy is on the road to recovery. Despite these protests, gold has another remarkable year. It was up 25% in 2010, which marked its 10th straight annual gain. Although we are speaking about gold today, I'd be remiss in ignoring silver's performance. Silver is up 78% in 2010, as it is, like gold, beginning to assume its role as a monetary metal. Platinum was also up 17%. When we look at the 10-year chart of the US and Canadian dollars, the euro, the British pound, and the yen, we see that these five major currencies have lost between 70 to 80% of their purchasing power against gold over this 10-year period. In truth, gold is not rising, but currencies are falling in value, and gold can therefore rise as far as currencies can fall. I'd like to pick up where we left off last year with a review of the three dominant medium-term trends that put upward pressure on the price of gold in 2010 and will likely continue in 2011. Then I'd like to look briefly at the three longer-term, irreversible trends that will put downward pressure on currencies, resulting in upward pressure on gold for decades. First, the three dominant midterm trends we discussed last year are central bank buying, movement away from the US dollar, and China. In 2009, for the first time in 20 years, monetary gold or central bank and investment buying outpaced gold buying for industrial or jewelry purposes. In 2010, China, Iran, Russia, and India's central banks were all significant buyers as they moved cash reserves into gold. In the third quarter of 2010, the Russian central bank gold holdings rose 7% to 756 tons, and the central bank bought two-thirds of its own gold production. In December, we learned that China had imported 209 metric tons of gold in the first 10 months of the year. This was a 500% increase over the same period of 2009, and on top of their world-leading domestic gold production. By the third quarter, India's gold imports, both commercial and private, for the year were 624 tons, putting them 100 tons above the previous year's total of 595 tons. Fourth quarter purchases could put India's annual total over 750 tons. China and Russia need to acquire gold to bring their gold reserve ratio to outstanding currency closer to the Western central banks. Russia needs to acquire at least 1,000 tons, and China at least 3,000 tons to remain on parity with the U.S. Chinese officials have stated publicly that China would like to acquire at least 6,000 tons. Unofficially, they have stated targets as high as 10,000 tons. Last year, we quoted a November 2009 story written by veteran journalist Robert Fisk, claiming Russia and China, along with France, were working on an agreement to trade oil with Arab states using currencies other than the U.S. dollar. As expected, central bankers fervently denied these rumors. The U.S. dollar has since 1973 been the only currency that oil could be traded in. This is the only reason the U.S. has been able to amass nearly $14 trillion in debt. Loss of the petrodollar's hegemony would have a devastating effect on the U.S., as this is essentially the only reason foreign countries in the past needed to hold U.S. dollars. On November 24th, 2010, China and Russia officially quit the dollar and agreed to use each other's currencies for bilateral trade, including oil. Official trading on Moscow's MISEX index began December 15, 2010. In 2009, Robert Zoellick made his well-publicized comment that the U.S. would be mistaken to take for granted the dollar's place as the world's predominant reserve currency, and that, looking forward, there will increasingly be other options to the dollar. In 2010, he continued hinting at a new reserve currency made up of 5 currencies with gold as the reference point. He also called for a new Bretton Woods agreement this year. Now, Mr. Zoellick is no lunatic goldbug. He is the president of the World Bank. Last month, I was speaker and panelist at the China Gold and Precious Metals Summit in Shanghai. I can confirm that Chinese buying, both official and public, is a major trend that is not only well in place, but may be the single most important influence on the price of gold in 2011. As I said, the Chinese see gold quite differently from the way we see it. If we are to understand gold's price direction in 2011 and beyond, I believe it is essential to understand the mindset the Chinese have built around gold. Although the forming of economic mindsets is a complex topic, I'd like to simplify how major financial mindsets are created. What our government, our banks, and financial media tell us about money is what most of us will accept as our financial mindset or financial reality. If anyone doubts the power of the government economic policy to shape economic reality, just look at how we have changed our attitudes toward debt, saving, and economic value over the past 40 years. Our current debt-based mindset began to form the day the U.S. dollar, as the world's reserve currency, was removed from its final international peg with gold in 1971. Although the West shares many common economic principles with the East, as the capitalist banking systems are similar, there is one area where there is a clear distinction. This is how Easterners view the role of gold as money. Western governments fear gold. It restricts their ability to create currency. In the West, governments borrow and encourage their constituents to follow their example. Banks encourage us to borrow from everything from vacations to widescreen televisions made in China. They tell us we're stimulating the economy through consumption. Generally speaking, the investing public in the West sees gold as a wealth-gaining asset to be traded like stocks and bonds. This is why Westerners are constantly fretting about the gold price in currency terms. The Chinese government, on the other hand, respects gold. This is evident by the laws they have passed to facilitate mining and private gold ownership. China currently leads the world in gold production. The government encourages the public to put 5% of their savings, yes, they encourage savings, into gold. This is significant because the Chinese can save up to 40% of their annual salary In the West, most middle-class families are lucky to break even. The Chinese see gold as a wealth-preserving asset that will weather all seasons. This is the difference, I believe, anyone who wishes to fully understand gold's rising price must comprehend. Inhabitants of older countries who have lived through the destruction of an inflation-fueled currency crisis do not need to be reminded that gold is the most effective hedge against inflation and a currency crisis. Former CEO of Newmont, Pierre Lassonde, also feels that it will be buying by the Chinese public that will eventually propel gold prices into the stratosphere. Clearly, the three medium-term trends we noted last year are still firmly in place. Now I'd like to take a look at three longer, irreversible trends that I believe will affect the price of gold and currencies for decades. These are the aging population, outsourcing, and peak oil. The aging population is a combination of a population that is living longer and the pig and the python effect of a huge tidal wave of baby boomers born between 1946 and 1963 who are just starting to enter retirement age. As people age, they spend less and downsize. GDP and tax revenues are reduced, and a much smaller workforce follows the baby boomers, so this is a triple whammy. This problem is universal. In China, it is further exacerbated by their one-child per couple policy, and governments will have no choice but to create more currency and further debase it. Outsourcing has almost entirely destroyed the manufacturing sectors of many first world countries like the US, Canada, and much of Europe. The Chinese worker who built your iPhone made $287 a month. This was after a well-publicized raise. The West simply can no longer compete with these labor costs. The United States was the world's largest manufacturer after World War II and has driven the world's economy ever since. However, the U.S. consumer can no longer buy things as they lose their jobs. As factories move offshore, the high unemployment becomes systemic. Without jobs, the GDP and the tax revenues of the U.S. will fall. The mountain of federal, state, and municipal debt will become even harder to service, and the government will be forced to go even deeper in debt and to further debase its currency. The final point is peak oil, which is at the maximum rate of global petroleum extraction is reached, after which the rate of production enters terminal decline. This has already happened in the U.S., Alaska, and the North Sea. The next few years, Mexico will become an importer of oil, and the U.S. will lose its third largest supplier. Our fragile, highly indebted economy relies on this land-based cheap oil to continue, and it cannot withstand the shock of transitioning to more expensive alternatives. In September of 2010, a German military think tank reported that the German government is taking the threat of peak oil seriously and preparing accordingly. Numerous studies around the world have concluded that we're very close to peak oil production, which will be accelerated due to the Gulf drilling bans. This will also lead to higher price inflation for most goods, and this will be a blow to the fragile U.S. economy, which currently pays less for oil and gas than any of the first world countries. When added to the effects of the waning strength of the petrodollar, the results will be devastating. May I remind you that if China, which currently has 1/10 the number of cars per capita as Americans, was to reach par with the United States, we would need, by one estimate, 7 more Saudi Arabias just to meet their needs. Now, these three megatrends, when put together, will continue to lower the GDP, lower the tax revenue, create higher trade deficit, create higher unemployment, and result in the need for further currency creation. This will cause inflation to rise as currencies depreciate in value, and create higher universal debt. All this means is that the gold price will continue to rise. Finally, as a direct result of worldwide debt and currency debasement, more people will be competing for the world's available gold. We discussed peak oil, but gold is also reaching a peak as fewer and fewer new deposits are being found. Smaller, lower-grade deposits with none of the economies of scale benefits of larger deposits are being put into production out of desperation. Mine supply has been in decline since the year 2000. As safe haven demand accelerates, there will be a transition from the approximately 200 trillion of financial assets to about 3 trillion of above-ground gold bullion. Of the 3 trillion of above-ground gold bullion, about half is owned by central banks and half is privately held. The privately held gold is largely held by the world's richest families and is not for sale at any price. The central banks are now net buyers. If the world's pension funds and hedge funds moved only 5% of their assets into gold, which these days would seem quite conservative, gold would trade above $5,000 an ounce. So in conclusion, I'll say that without any new financial crisis, both mid-term and long-term trends are in place to ensure gold and silver will continue rising through 2011 and well beyond. For those of you who are looking for a prediction, last year at the Empire Club I forecasted the price of gold to be between $1,300 and $1,500 at the end of 2010. We ended up right in the middle at $1,405. For 2011, I recently forecast it may climb to between $1,700 to $2,000 per ounce, and that's just based on the last 5 years' performance and the factors I have presented today. I encourage you to follow the example of those who know how devastating a currency crisis can be and buy gold to protect wealth and not treat it as a speculation. I'd like to close with a quotation that seems to put all of this into perspective. It comes from Norm Franz's appropriately titled book, Money and Wealth in the New Millennium. He said, "Gold is the money of kings, silver is the money of gentlemen, barter is the money of peasants, but debt is the money of slaves." Thank you.